To set up your account, activate the account and select the employer contributions if that is applicable. When ticked, the nominated employer contributions are automatically added to the account. Next, you will need to enter your current account balances according to the three categories. The graph displays the value of each part of your fund according to the contribution type. You can also view the total value of your account in both future and present value. Employer contributions are automatically allocated when the option is activated. Personal contributions may be made as either after-tax or pre-tax contributions. Contributions may be made on a year-by basis, including additional contributions your employer may make above the automated amount. If you want to make regular monthly personal contributions, these must be allocated in the investment plan. They will need to be allocated in 5 yearly lots. Data view will display details of account balances, contributions, income, and costs. Graph view will display all the information you require on a year-by-year basis. The investment profile can be managed for different time periods and risk profile. The returns on the pension fund are allocated as a combined income and capital growth. Numerous options are given for your fees and insurance. It is a simple matter to switch to a new profile. The profile name and the returns are not linked. There is usually a switching fee to have your account details changed. Some funds will give a small rebate on management fees for high account balances. Note the activation key so that you may turn the information off without losing the data. You do have the option to change to a new fund, but keep all the information regarding both pension funds in one place. When you start the new fund, you can change the returns, costs and insurance and make changes to the investment profile as required. There are normally fees associated with changing funds, and these can be entered. In the data view, you can see the name of the fund and the investment profile in the first year of the change. Note the cost of changing to the new fund in year 11. This is a retirement plan where the person plans to work part-time for 2 years. An investment profile has been set out to meet the changing risk intolerance. A transition to retirement has been selected so that contributions can be made from part-time employment. The fund is to be drawn down over 25 years. An additional $20,000 is to be withdrawn in year 6 to fund a new car. Employer contributions will automatically be withdrawn from the salary. In the retirement plan, a schedule of income requirements have been created. Note the lower amount in the first 2 years, the additional money in year 6 to purchase a car. Graph view shows all the details on a yearly basis, and data view shows details in 5 yearly lots. This pension drawdown plan is very versatile and should meet the requirements of most people. The drawdown amount is going to be allocated according to percentage of fund, with an additional $20,000 withdrawn in year 6. Note the healthy account balance at the end of year 20. The second drawdown is increased to 20% to see how long the funds will last. Because a percentage keeps taking a percentage of smaller amounts, the amounts over the last few years may not be adequate. This problem with using percentages can be overcome by having a minimum balance which meets your needs. In this case, the fund will be closed with a balance reaching $30,000. The amount is indexed each year. Note the drawdown amounts during each 5-year period. The fund will be closed in year 18. The third method of drawdown is a rollover to annuity. First, the drawdown must be activated, and then proceed to the tab for Roll into Annuity. The information regarding the first payment amount should be obtained from the group selling the annuity. Annuities may be a lifetime annuity or for a specific number of years. The payments may remain the same for the life of the annuity or increased at an agreed rate. The first option is to increase the amount at the same rate as inflation. The second option is to nominate a specified annual rate. The annuity payment will change according to the length of the annuity and the rate of future increases. This information must be sought from the company providing the service. Once the lump sum has been converted to an annuity, all the rules of drawdown cease to apply, including the making of additional payments in the drawdown amount. This fund has a balance of $100,000. Employer contributions are allocated on a salary of $100,000. The investment return is 7% with a management fee of 1%. The value of the fund is expected to be $263,000 at the start of year 10. Using the capital growth modulator, the program will consider a fall of 15% over a 5-year period. This will result in a fall of $28,000 in the balance of the fund by the start of year 10. This pension fund has a $600,000 balance at the start of retirement. The fund is returning 7% with a 1% management fee. The plan is to draw down the balance at a rate of 5% per year. At the start of year 10, the present value of the account will be $500,000. The present value drawdown amount for year 10 will be $25,000. Using the capital growth modulator, the program will consider a fall of 15% over a 5-year period. The present value balance at the start of year 10 will fall from $500,000 to $443,000. The present value drawdown in year 10 will fall from $25,000 to $21,600. This fund has a balance of $100,000. Employer contributions are allocated on a salary of $100,000. The investment return is 7% with a management fee of 1%. The value of the fund is expected to be $262,000 at the start of year 10. Historical data using average returns for the 10-year period from 2000 is 12.43%. The value of the fund is expected to be $370,000 at the start of year 10. Returning to historical data, the 10-year period from 2005 is selected, changing the average return to 10.07%. The value of the fund is expected to be $318,000 at the start of year 10. Using historical data gives you a range of other outcomes. However, past performance does not necessarily repeat itself when anticipated. This pension fund has $600,000 at the start of retirement. The fund is returning 7% with a 1% management fee. The plan is to draw down the balance at a rate of 5% per year. At the start of year 10, the present value of the account will be $500,000. The present value drawdown amount in year 10 will be $25,000. Historical data using average returns for the 10-year period from 2000 is 12.43%. Present value balance will rise from $500,000 to $775,000. The present value drawdown in year 10 will rise from $25,000 to $38,700. Returning to historical data, the 10-year period from 2005 is selected, changing the average return to 10.07%. The present value balance will rise from $500,000 to $648,400. The present value drawdown in year 10 will rise from $25,000 to $32,400. Using historical data gives you a range of other outcomes. However, past performance does not necessarily repeat itself when anticipated.